Look, we need to talk about what's really happening in the American economy right now because on the surface, the numbers don't make sense. You've got GDP growth roaring ahead at 4.4% annualized in the third quarter of 2025, consumer spending holding strong, exports rising, and yet the job market is barely moving. Companies added only 50,000 jobs in December with forecasts of maybe 75,000 in January. That's a fraction of what we saw during the hiring boom of 2021 to 2023, when employers were adding 400,000 jobs a month. So what's going on? Why is growth disconnected from hiring? To understand this, you need to see the economy like a machine, understand the cause-effect relationships at work, and embrace the reality that we're watching a fundamental structural shift, not just a temporary blip. Let me walk you through the machine. The first thing you have to understand is that GDP growth and job creation are connected through productivity. When an economy grows, it can do so in two ways, either by adding more workers or by making existing workers more productive. For decades, we've seen both happen together, but what we're witnessing now is a divergence. The economy is growing, but it's growing through gains in productivity, not through adding bodies. Companies are figuring out how to produce more with fewer people thanks to advances in artificial intelligence, automation, and process optimization. Dow Chemical is cutting 4,500 jobs while shifting to more automation and AI. Amazon is eliminating 16,000 corporate positions. UPS is cutting 30,000. These aren't distressed companies. They're adapting to a new production function where technology substitutes for labor. The second part of the machine is the interest rate environment. The Federal Reserve spent 2022 and 2023 jacking up rates to fight inflation, and those rates stayed elevated through much of 2024 and into 2025. High rates work by slowing down borrowing, investment, and hiring. The effect doesn't hit all at once. It moves through the system with lags, typically 6 to 18 months. So even though GDP is strong now, the hiring decisions companies made months ago were constrained by tight monetary policy. They hesitated, they delayed, they optimized with the people they had rather than adding headcount. That hesitation is showing up in the payroll numbers today. The third part is uncertainty, and this is critical. President Trump's trade policies have been erratic. Tariffs go up, then they're negotiated down, then threats are issued, then deals are hinted at. When businesses don't know what the rules of the game will be 6 months from now, they pull back on commitments. Hiring is a commitment. You bring someone on, you're making a bet on future demand, future costs, future revenue. If you can't see the landscape clearly, you don't make that bet. You wait, you use contractors, you automate, you squeeze more out of your existing team. That's radical truth right there. Uncertainty kills hiring faster than a recession does, because in a recession, you know it's bad, but in uncertainty, you just don't know, and not knowing paralyzes decision-making. The fourth piece is immigration. Under Trump's crackdown, the flow of foreign-born workers into the U.S. labor market has slowed dramatically. In 2023, the economy needed to add about 250,000 jobs a month just to keep the unemployment rate steady because so many new workers were entering the labor force. By mid-2025, that break-even number had fallen to around 30,000, and some researchers at Brookings think it's now as low as 20,000 and dropping. What does that mean? It means that even weak job creation, say 50,000 or 75,000 jobs a month, is enough to keep unemployment from rising. The unemployment rate sits at 4.4%, which by historical standards is quite low, so the labor market isn't collapsing, it's just not expanding, it's in a holding pattern. Now let's talk about the revisions, because this is where things get messy. Every year the Labor Department goes back and adjusts its job numbers based on more accurate data from state unemployment agencies. Last September, they put out a preliminary estimate that they might have to subtract 911,000 jobs from the year ending in March 2025. That's not a small error. That's nearly 1 million jobs that may not have existed. The final benchmark revision is coming out now, and economists expect it might be slightly smaller, but still enormous. On top of that, there are additional revisions to more recent months to account for business births and deaths, the opening and closing of firms. Some estimates say those revisions could knock off another 20,000 to 30,000 jobs per month from April onward. Fed Chair Jerome Powell himself said the numbers might be overstating job creation by 60,000 a month. Put it all together, and you're looking at a scenario where the U.S. economy might have actually lost jobs in 2025, the first annual decline since the pandemic year of 2020. So here's where we are. The official story says the economy is booming. The reality is more nuanced. Yes, output is up. Yes, consumer spending is solid. But the job market is weak. Revisions are erasing nearly a year's worth of reported gains, and the structure of the labor market is shifting in ways that break the old rules. This is a moment that requires thoughtful, unemotional disagreement with the surface narrative. Don't just accept that strong GDP equals a strong job market. Dig into the mechanics, ask why, look at the cause-effect. Let me give you the trade-offs we're facing, because every path forward has costs and benefits, and you need to weigh them clearly. The first trade-off is automation versus employment. On the one hand, automation and AI make companies more efficient. They boost productivity, lower costs, increase profit margins, and allow the economy to grow without inflationary pressure from wage increases. That's great for shareholders, great for consumers who get cheaper goods, and great for GDP. On the other hand, it means fewer jobs, especially at the entry level and in roles that are repetitive or process-driven. Young people entering the workforce face stiffer competition, not just from other humans, but from algorithms and machines. The benefit is economic efficiency. The cost is labor market displacement and rising inequality between those who own capital and those who sell labor. The second trade-off is immigration policy. Restricting immigration reduces the labor supply, which in theory should put upward pressure on wages for existing workers. That's a win for native-born workers, especially in lower skill sectors. It also lowers the break-even point for job creation, which means the economy can grow with fewer new jobs and still keep unemployment low. But here's the cost. A smaller labor force constrains long-term growth potential. If you don't have enough workers, you can't expand production as fast. You hit capacity limits, you get bottlenecks. And in industries that rely on immigrant labor, like agriculture, construction, and hospitality, you get labor shortages, higher costs, and slower output. So you get short-term wage gains for some workers, but long-term growth constraints for the whole economy. The third trade-off is interest rates. The Fed kept rates high to crush inflation, and it worked. Inflation has come down. But high rates also suppress hiring, investment, and risk-taking. If the Fed cuts rates now, it would ease some of the pressure on businesses, encourage borrowing and hiring, and potentially close the gap between GDP growth and job creation. But if they cut too soon or too fast, they risk reigniting inflation, especially if productivity gains don't keep pace with wage growth. The benefit of cutting is short-term stimulus. The cost is long-term price instability. The benefit of staying tight is inflation control. The cost is prolonged labor market weakness. Now let's talk about believability-weighted decision-making. If you're trying to make sense of this situation, you can't just listen to everyone equally. You need to weigh opinions by track record and logic. Who has been right about this kind of shift before? I'd be listening closely to people who understand productivity cycles, like Robert Gordon at Northwestern or Eric Brynjolfsson at Stanford, both of whom have studied how technology affects employment. I'd be paying attention to Fed officials who focus on labor markets, like Mary Daly at the San Francisco Fed, because they have real-time data and boots-on-the-ground insights. I'd also be watching CEOs in the automation and AI space, people like Satya Nadella at Microsoft or Jensen Huang at NVIDIA, because they're building the tools that are changing the production function. And I'd be skeptical of politicians on both sides who are spinning the data to fit their narrative. Politicians have low believability on economic mechanics because their incentives are political, not analytical. Here's a principle. When the data diverges from the narrative, go to the pain rather than avoid it. The pain right now is that the job market is weaker than the headline GDP numbers suggest. A lot of people want to ignore that pain because strong GDP feels good, but the pain is the signal. It's telling you that something structural is changing. If you avoid it, if you keep assuming the old relationships still hold, you'll be blindsided when the system doesn't behave the way you expect. Pain plus reflection equals progress. Reflect on what's different. Productivity is rising, labor demand is falling, immigration flows have reversed, interest rates are high, but inflation is down, the machine has new gears. Another principle, embrace reality and deal with it. The reality is that the economy can grow without creating a lot of jobs. That wasn't true 20 years ago, but it's true now. If you're a policymaker, you need to deal with that reality by thinking about how to support people whose skills are being automated away. If you're an investor, you need to position for companies that benefit from productivity gains, not just revenue growth. If you're a worker, especially a young one, you need to build skills that complement AI, not compete with it. You need to be adaptable, not rigid. The world doesn't care about your old mental models. It rewards those who update their models based on new data. Let's talk about the idea of meritocracy for a second. If we were running this economy like an idea meritocracy, we'd be having open, radically transparent debates about what to do. We'd put all the data on the table, including the ugly revisions. We'd invite the most believable people, the ones with the best track records and the clearest logic, to argue their positions. We'd listen to disagreements, not shut them down. We'd test policies like experiments, not as ideological crusades. But that's not what's happening. Instead, you've got political camps cherry-picking data to support their side. You've got media outlets amplifying whatever fits their audience's biases. You've got social media echo chambers where people reinforce their priors instead of updating them. The lack of radical truth and radical transparency in our public discourse is making it harder to navigate this shift effectively. Here's another principle. Second-order effects matter more than first-order effects. The first-order effect of strong GDP growth is that it feels good. Tax revenues go up, stock markets rally, consumer confidence rises. But the second-order effect is that if job creation doesn't follow, inequality widens. Those who own capital benefit from productivity gains, but those who depend on wages get left behind. The third-order effect is political instability. When a large segment of the population feels economically insecure, they lose trust in institutions, they become more susceptible to populist narratives, and they vote for disruptive change. That's how you get policy volatility, which feeds back into business uncertainty, which suppresses hiring even more. You get a negative feedback loop. You have to think through the chain of consequences, not just the immediate result. Now, let's talk about what this means for positioning. If you're managing money, you want to be in companies that are driving the productivity gains, not the ones being disrupted by them. Technology, automation, AI infrastructure, software that eliminates manual processes, these are the winners. You want to be underweight on sectors that depend on large labor forces with low productivity growth, like traditional retail or parts of the service sector. You also want to be cautious about small businesses because they're the most vulnerable to uncertainty and high rates. They don't have the scale to automate easily, and they can't absorb shocks the way big corporations can. If you're thinking about the bond market, you need to watch the Fed closely. If job creation stays weak but GDP stays strong, the Fed has room to cut rates without worrying too much about overheating. That's bullish for bonds in the short term. But if productivity gains start to plateau and wage growth accelerates, that changes the picture. You get inflation risk again and bonds sell off. The key variable is productivity. As long as productivity growth is high, the economy can grow without inflation, and the Fed can stay accommodative. If productivity growth slows, the trade-offs get ugly fast. For currencies, a strong economy with weak job growth is actually a mixed signal. On one hand, strong GDP supports the dollar because it signals economic resilience. On the other hand, weak job growth gives the Fed reason to cut rates, which is negative for the dollar. The direction will depend on which variable dominates. If global investors believe in U.S. productivity gains, the dollar stays strong. If they worry about labor market fragility, let me be clear about what to watch going forward. You need to be monitoring 5 things continuously, and you need to understand the cause-effect between them. First, watch productivity growth. If productivity keeps rising, the divergence between GDP growth and job creation will persist, and that's actually not a crisis, it's a structural shift. But if productivity growth stalls, then weak hiring becomes a warning sign of deeper economic trouble. Second, watch the Fed's reaction function. Are they cutting rates because they see labor market weakness, or are they holding steady because they see strong growth? Their decision will tell you how they're weighing the trade-offs. Third, watch credit spreads. If businesses are confident about the future, credit spreads stay tight. If uncertainty is rising, spreads widen. That's a leading indicator of stress. Fourth, watch immigration data. If the foreign-born labor force continues to shrink, the break-even point for job creation will keep falling, and unemployment will stay low even with weak hiring. But if immigration policy reverses, the break-even point jumps back up, and you could see unemployment rise quickly. Fifth, watch business investment in automation and AI. If companies are pouring money into technology, that confirms the productivity story. If investment slows, it means they're uncertain about returns, and that's a red flag. So here's where we land. The U.S. economy is growing, but the job market is lagging, and the divergence is real, not just a data quirk. The cause is a combination of rising productivity from AI and automation, lingering effects of high interest rates, policy uncertainty, and reduced immigration flows. The trade-offs are clear: efficiency versus employment, short-term wage gains versus long-term growth, inflation control versus labor market support. You can't have it all. You have to choose which costs you're willing to bear. The principles that apply here are the same ones that apply in any complex system. Embrace reality and deal with it. Go to the pain rather than avoid it. Think about second-order effects, weigh opinions by believability, and build feedback loops so you can learn and adapt. This is not a moment for wishful thinking. This is a moment for clear-eyed analysis and disciplined positioning. I'll close with this. The worst thing you can do right now is cling to old mental models. The relationship between GDP growth and job creation has changed. The structure of the labor market has changed. The role of technology and production has changed. If you keep expecting 400,000 jobs a month because GDP is strong, you'll be disappointed and confused. But if you update your model, if you understand the new mechanics, you won't be surprised. You'll be prepared. You'll see the opportunities and the risks before they become obvious to everyone else. That's the edge that comes from thinking in principles, from building systems, from being radically honest about what's real and what's not. The data is messy, the revisions are large, the signals are mixed, but the underlying machine is still knowable if you take the time to understand it. That's the work. That's always the work.